Hello, I'm Peter Switzer. Welcome to the program that helps you make the absolute most of your money. Now for his fortnightly look at the shares he likes and the ones he doesn't like, and to reveal 5 stocks that he thinks has improved its ratings in recent times, please welcome Switzer regular Roger Montgomery. You've told me that there are at least 5 companies that have improved their quality. Is that what you're saying?
Yeah, well, I look for 3 things, and I've talked about this before. I look for a business that's great quality.
Yeah.
I look to buy it at a discount to its intrinsic value, and I'm looking for a business with bright prospects for its intrinsic value to increase.
Yep.
So they're the 3 things I'm after. Companies come onto my radar, and I might not necessarily buy them because they might not be cheap or I don't think their prospects are any good.
Yep.
But if their quality improves, they go sometimes from non-investment grade to investment grade. If you like, they go from junk bond status to commercial bond status, reasonable, they might be BBB or AAA. So I rank companies from A1 down to C5.
Is there a famous one that you first thought was crap, to put it the way I would, and then became a really good company?
Well, there was a company, many of you know this, JB Hi-Fi, and in its early days it had a fair bit of debt. Yeah. So its quality wasn't as good as it was once it paid down that debt. The rating system that I've developed and that I use, its objective is to weed out the companies that have a higher probability of catastrophe. And obviously debt is one of those things. If a company's got a lot of debt, there's more risk.
So you could actually change your attitude towards Wes farmers if they sold off their coal mining and improve their balance sheet.
Yeah, or if they spun off coals.
Yeah. Something as simple as that.
Spun off coal or spun off coals. Either way, it goes back to what they were.
Right, okay.
So here are some business that have moved up the ratings from what I would regard as either non-investment grade or less than, lower than where I would draw a line, worse than where I draw the line. Okay, so Alumina is a company that went from B3 to A3. Now, the performance rating stays the same, so the 3 has remained the same. So its stability of performance and its predictability of performance hasn't really changed that much, but its balance sheet has become stronger. And so it's gone from a B3 to an A3. And I have to say at the outset, there's about 37 or 38 different ratios that I look at to come up with these ratings, and I don't look at them only in an individual year, I look at them longitudinally as well. And so I'm interested to see how those ratios have changed over time, and we measure that change. So there's quite a bit involved.
And Alumina is a company that's really had sort of a black cloud hanging over it for some time. Yeah. But you're saying that black cloud is going a lot greyer.
The balance sheet is getting better. Yeah. The balance sheet's getting better. The performance remains as it was. It's a 3, it's not a 1. Yeah. Woodside is another one. We all know Woodside very well. It's gone from a C4, which is not investment grade, that's the 2nd worst rating, to a B3, which is about middle of the road. Telstra's a B3. So it's come up a long way in one annual period.
So what was the great negative on Woodside? Was it debt?
Well, it was a number of things, but debt was certainly one of them.
Management team?
No, we don't measure management. Very hard to measure management. That's more a qualitative rather than a quantitative assessment. But debt is one of them. The change in that debt over time is another big one. The performance of the working capital is another thing that matters. Boart Longyear is another business. A4, not investment grade for me. A3, just on investment grade.
And that's a company a lot of people do like. So would you actually include it in your fund at an A3?
Probably not. I'll tell you why. Capital intensity for me is a big issue. I like to avoid businesses that are highly capital intensive, and Boart Longyear is. So I probably wouldn't have it in my portfolio. So I'm not mentioning today stocks that I would buy, but ones that have had significant improvement in their quality.
And so for some people, listeners who actually hold these stocks, that might make them feel a little bit better that actually you've noticed an improvement in their rating.
Oh, absolutely. Yeah. Well,
we'll also talk about, because I know you're concerned.
There's certainly something that I keep an eye on. I'm looking for improving companies because they're improving. If the share price is going down and the business is improving, well, that's precisely what you want.
That's the gap you like.
A couple of others, very, very quickly. Aluka Resources. I know many of your viewers are interested.
How many people have lost money on Aluka Resources over the years?
Well, it was a C4, which is again 2nd worst rating that I've got. The worst rating's a C5. C4 is the worst. Jumped to a B2. And a little one, G8 Education. This is an interesting one because it's gone from the worst rating, C5, to the 2nd best rating, an A2, in terms of quality. G8 Education.
G8?
G8, G for gecko, 8, the numeral 8. And the last one that I'll give you is Calliden. Calliden's gone from an A4 to an A2. So go out, have a look at them, find out, have a look at the balance sheet.
The chairman of Calliden's been on this program.
This is the challenge. Go out and have a look at the balance sheets of these companies and their performance, and look for the material differences. See what's materially changed over the last couple of years, and you'll get a sense of why these things have become better quality.
Can we go back to G8?
Sure.
G8 again?
G for gecko, 8. The numeral 8, education.
Education.
It was only today that I discovered it was an A2.
Okay. Previously
it's been a C5, so I haven't even looked at it.
So all this stuff which comes objectively in your computer,
absolutely.
Boom, it spits it up.
And this is a really important insight into the way I go about investing. I don't spend any time looking at things that don't meet my criteria. I just say no. If it's a C5, it's a no. So I don't spend any time looking at it. But I'm interested now, and as I was going through this list, I was thinking, oh, G8, better go and have a look at that one, because now it's an A2. I'm going to spend a little bit of time on it.
You also are worried that some people who hear you mention a company, that by definition you're saying this is something that I'm recommending. You don't make that clear.
Let's spend a minute on this, because I come off this show and I mention a stock, and the next day the thing goes through the roof, and I'm very, very concerned.
I am too.
I'm concerned because I always tell people to go and do their own research. Now, there is no way they've researched a company between the time you and I have spoken about it in the evening and the next morning. They simply haven't done it. So they're acting irresponsibly when they go and do that. I may have bought the stock, but I may have paid a lot lower price than what people are going out and buying it for. Now, as much as possible, I give the intrinsic value for the company, and I tell people on your show what I think the intrinsic value of the company is. I wouldn't pay more than that, and if the share price goes above that, I may be a seller, and as you know, I'm under no obligation to come back and talk about it again. You might never ask me about that stock again. So it's very important that people seek and take, and they must do this, seek and take personal professional advice. I don't know whether the stocks we mention are appropriate for their portfolio or not. I'm certainly no good at predicting where share prices are going. They could halve or worse, and I'm not in the business of predicting share prices, and I'm very patient. I'm quite happy if a share price halves and I don't believe that the intrinsic value has changed, I'm quite happy to buy more. But other people who are watching the show, they might buy too much of the stock, and if it halves, they wipe themselves out. They've got to do their own research. They absolutely need to do their own research.
Okay. Now let's go to Zycom.
Zycom is a company that fits into this category of be warned. It's a thinly traded small, it's a micro cap. It makes very large ship-mounted winches, 150-ton winches that are on oil and gas vessels. Now, you might think that's very exciting.
But I guess there's a lot of demand for those sorts of vessels. Well, I've talked to you a lot about the oil price going up. I believe this business is in the right space, because there's going to be a lot more offshore drilling going on, and you can see that in the global fleet of offshore rigs. It's increasing, and the demand for rigs is increasing. Demand to manufacture rigs is increasing. Utilisation rates seem to be dropping, but that's by the by. And so that's one of the businesses. Now, its only other major competitor, it's one of the, it holds a substantial market share. Its only other competitor is Rolls-Royce. It's based in Singapore. People are going to balk at the fact that it reports in Singapore dollars. The board is Singaporean. It's got businesses in Singapore. But if you want to be leveraged to growth in Asia, you'd probably want to have your business in Singapore rather than in Sydney. Its other business hasn't been going so well, and that's the manufacture of cement mixers. But again, it's got almost 40% market share in Australia and Asia for that. They've just built a new facility in Thailand, I believe, which means it's going to be cheaper for them to manufacture these things. They've been in business for a very long time. The board seems to know what they're doing. The son of the CEO is a Columbia graduate, I believe, and this is a business trading at a discount to its intrinsic value. A broker's put out a recommendation today, I believe, or yesterday. They said it's going to earn 9 cents a share. I've got it earning 7 cents a share next year, which gives me an intrinsic value of 52 cents. I've bought the shares at 32 cents, up to 42 cents. What are they nowadays?
I think they're about 46 cents at the moment. So there's not a lot left. I don't believe there's any government involvement here. Look, it's tied to what I think is a positive space, and that is offshore drilling for gas, which is a great alternative to oil if the oil price goes up, and oil itself.
Roger, fantastic as always. See you in a couple of weeks' time.
Okay, thanks.
Cheers, mate.